Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Rob Romano, our Director of Research. Now, Rob, we just got through two big events in the market. We had the debt ceiling get passed, which was a nice relief. And then for the first time in 11 meetings, the Federal Reserve actually held rates the same, which I think means we can go on to talk about normal investment stuff. So let's talk a little bit about what's going on in earnings, which we know drive stock prices.
Yeah, Paul, one big question mark heading into the year was the debt ceiling. And now that that's been resolved, investors are focusing on those rate hikes and the impact of those rate hikes on corporate earnings. So in the first quarter, corporate earnings were down 2% year over year. That's versus expectations of down 6% year over year. So better than expected. Sales were up 4% year over year, which is a pretty good number given the economic environment. So on one hand, we have sales up year over year. On the other hand, we've got earnings down year over year. So what is the difference? On this graph here, you can see operating margins peaked in the first quarter of 2022, and they've been on a steady decline since. The primary reason being that tight labor market and higher labor costs. In addition to that, we're seeing higher financing costs as the cost of carrying that debt is more expensive. And the response from corporate America has been to rein in costs, to cut costs. And we're seeing that throughout corporate America, especially within technology. We heard from the likes of Microsoft, Salesforce, Facebook, now called Meta, Google, and Amazon. And they've labeled this the year of efficiency, of becoming more productive. With that said, in the second half of the year, we expect economic growth to continue to slow, and this will likely keep pressure on margins.
So obviously margins are a big part of our conversation, but we're also seeing something unique in the stock market and this idea that really 10 stocks are kind of driving the market. It's a very concentrated rally. Can you help explain to our watchers what's really going on with that?
Yeah, it's been very concentrated. If we look at the S&P 500, that's the 500 largest publicly traded companies in the U.S., the performance is about up 14 to 15% year to date. So it's been a very good year. But if you look beneath the surface, it's telling somewhat of a different story. The S&P 500 is a market cap weighted index, meaning the largest companies have a larger impact on the performance of the index. And on this graph here, you can see that it's those very large companies that are driving performance. Specifically, it's the top 10. The top 10 represent 30% of the index, and they're driving over 90% of the return year to date. Again, these are very large companies. Apple, Amazon, Tesla, Google are a few of them. But when we look beyond those names to the remaining 490, the performance of that collective group is roughly 1 to 2% per year. So we haven't seen the market broaden out like we would expect in a fairly strong upturn. And we can go even one step further. We can look at the equal weight index on the S&P 500, where every company is weighted the same. The performance on that index is 10% behind the market cap weighted index. So what investors really want to see is the market to broaden out here, more participation. And that would mean better performance in mid cap, small cap, and sectors outside of technology.
Truly an interesting time to be managing money. Now, part of the reason of that concentration really has to do with AI or artificial intelligence. So, Rob, let's talk a little bit about AI and the real part and maybe the hype part.
Yep. AI's been all the buzz, all the excitement. And I'm going to start with the definition of artificial intelligence, AI, and what it is. It's simply machines and computers performing complex tasks. And what makes it different is these tasks are more human-like in nature. So think of reasoning, think of learning, think of interacting, speech recognition. So one example of AI is Amazon Alexa. The technology behind that is built off artificial intelligence. Another one is ChatGPT, which is the fastest app to 100 million users. They did that within 2 months. So you can use ChatGPT to create essays, emails, presentations, and other type of documents. So who do we think the winners are going to be in this AI race? Again, we think it's companies who embrace the technology, who use it within their businesses to become more productive and more efficient. Because the real value of AI is not necessarily in the systems themselves, but it's how employers and employees use those systems to become more productive. You can think of the factory floor and how that's been transformed, where you have devices on the factory environment that are communicating with each other, that are connected, and they're sending data to other locations where it can be analyzed. AI does very well with large amounts of data. So think of like the drug discovery process, where it could really speed up that process. Who do we think the winners are going to be in the marketplace? We think it's going to be like the gold rush. So the companies who supply the picks and shovels. In this case, that's the semiconductor companies. Again, these companies have done very well here recently. So we caution, we think they are ahead of themselves a little bit here. But artificial intelligence requires massive amounts of computing power and energy, and it's these semiconductors that really provide that. So at the end of the day, we think the U.S. is going to lead in artificial intelligence the same way we led in internet technology in the late 90s, software, cloud computing, and the way we lead in leading edge semiconductor design.
Rob, that's some great comments. And just for our viewers to make sure you know that Rob and I are actually live shooting this video. This is not a deep fake AI created event. And every comment we made is actually our own. We did not go to ChatGPT to have it written for us. As always, thank you for the opportunity to serve you and your family, and have a great day.